Hi, I'm Aoife Devitt, and welcome to this week's Markets Happy Hour podcast. It has been a week filled with news again. It hasn't been quite as tumultuous in markets, but we have just today, Thursday, had more developments in terms of the direction of the US central bank, the Fed, and we are listening and watching for what this is likely to mean for risk assets. So, as usual, we have a great slide deck to go through and look forward to taking you through some of the slides that have got my attention this week. So I've called this podcast, Are We There Yet? And the there is, of course, at a point of recession. We know that the forecasts of a US recession have greatly picked up since Liberation Day, and in effect, since it was clear that the Trump administration was serious about its tariff imposition. We also saw that in the aftermath of Liberation Day, probability of recession had gotten to as high as 45%, at least as stated by Goldman Sachs, and they had then retrenched and reversed that prediction once it seemed that there would be a pause on the Liberation Day tariffs. But as we will show later, it is quite clear that the negotiation with the 70 or so countries that are now subject to negotiation when it comes to tariffs is going to be protracted without instant feedback and without instant results. So perhaps we are going to be looking at those recession probabilities ticking upwards again. As usual, we have our 5 topics: inflation, interest rates, geopolitics, equity markets, and other asset classes to cycle through. And this week, we are looking at the ongoing disturbances. We've spoken about the massive disturbance that the Liberation Day tariffs created in markets and the ripple effects that that had around the world. We are continuing to deal with the effect of those disturbances. Most recently, just this week, there has been increased rhetoric around the independence of the US Fed. We've had the president suggesting he would like to fire the chairman of the US Fed. And there have been standoffs in some cases between the US Fed essentially and the US government as we think about the probability of recession and the probability that tariffs will have a direct impact on prices and skew some of the metrics that the Fed has been focused on. So I'd say that markets are certainly not in the mood to party at this point. They are showing ongoing volatility, some ongoing movement, and the most really acute case of that is when we look at just how some stocks are being punished severely when they fail to meet expectations. And a case in point there today was the health insurance stocks, most pointedly United Healthcare. We know that trade is continuing to drive the geopolitical equation and calculus, and that has not changed in the week we've had. Although we can also see that the two speeds of the different economies around the world are starting to emerge, particularly where inflation is more convincingly in check, as is the case in Europe, and not yet convincingly in check, perhaps in the US. And then, of course, our question remains at the end of the week as we enter the Easter weekend: where do we go from here? So let's look at how the Trump trade is actually playing out. This is a chart we've shown in some form or other at other podcasts, but we can see that if we take this right back to April of last year, so we're really going back a full year, full 12-month period, we can see that the dollar rose dramatically in the aftermath of the election. It is now essentially retraced all of those gains. It is back to its low point that we saw before the election. We see that the US Treasury yield has equally shown quite a bit of volatility. It has hovered between the 4 and the 4.5% level. The last time it got low was when, again, we had this this bullish sense that we were looking at a low interest rate, that was what the US Treasury Secretary was focused on. When it looks in terms of the Mag 7 relative to the other 493, while they broke away in the last 12 months, most of that has already been reversed. And then we look at the S&P relative to the rest of the world. We see that the S&P, again, similarly did break away and has not completely retraced its steps there, but has retraced significantly back to where it was in the preceding the elections. So a lot of trades have essentially been reversed, and that's a sign of just how sentiment is starting to either revert to the mean or make itself clear in very different directions. Last week, we showed consumer sentiment charts, and we've been looking both at consumer sentiment and small business sentiment. I thought this was interesting to ask the US public how they saw tariffs taking an effect. And for those of you not on YouTube and listening, what this chart essentially shows is that the majority of a survey said that they thought there would be a bad effect on both the US and on the individual of tariffs. That number is over 50%. So clearly they have been listening to the economic forecasters and just understanding the effect that tariffs have on pricing. That's considered to be a negative effect. As far as having a good effect, only 10% of Americans see that tariffs will have a good effect on themselves. And maybe they are they're domestic manufacturers. They see that tariffs will affect their competitors and not themselves. But a larger amount, close to 25%, think that tariffs will have a good effect on the US. So we can see here the somewhat tenuous success, but still success nonetheless, of the narrative that has been spun around tariffs being in line with the American First agenda and in line with the need to reindustrialize parts of the United States and essentially unravel some of the so-called unfair treatment that we've seen in place. So a very mixed, I'd say, picture there, but definitely the lion's share of respondents are negative on tariffs. And this will, I believe, have a knock-on effect on consumer sentiment, even if consumer sentiment already being low is not fully reflecting the effect of tariffs, given it has been a relatively recent phenomenon. I think we know that it is going to all contribute to the consumer sentiment falling more. When it comes to recession watching, we've spent a lot of time looking at Polymarket odds when it was the US election, and we know that Polymarket was very much in favor of a Trump victory, and it proved to be right. And we can see now that the odds of a US recession have nudged higher than 50%. They have been as high as 60%. And these we could suggest that this is sort of the weight of watchers around the world, and this is the odds are predicting a formal downturn this year. The other interesting status is the typical pattern that we see in terms of when a recession is actually announced and how far along we are. Last week, we spoke about equity markets being a leading indicator, and that essentially by the time equity markets corrected, that was essentially discounting in some of the effect of a downturn, and that the actual pain would not be felt on Main Street until sometime after equity markets have bottomed. So there was a harbinger certainly of pain to come. And what we can see in this chart in the top left is that when we look at the '08 recession, it wasn't confirmed until the S&P had fallen almost 50%. So I think this is again a question of by the time a recession is actually confirmed, we will probably have had quite a bit of pain in the equity markets already. And given we have not had a 50% fall, it suggests that we need to look much more at the rumblings of recession as opposed to the actual confirmation that it is here. And we've also already had some confirmation from some market watchers that a recession is already upon us. And that's been a common refrain of some strategists as well as some asset management heads just in recent days. They already perceive a recession. And when we discuss in a little bit the effect on United Healthcare of some of the announcements, the earnings announcement just today, we can see that there are some warning signs in there about about a squeezing cost structure and just challenges for the healthcare segment. I thought this was an interesting chart. This comes from Goldman Sachs and ultimately KKR's materials, where we looked at, well, what kind of recession are we actually discussing? And we've heard a lot about self-inflicted wounds and why this recession is not the same as the '08 recession. We've heard debates in suggesting that the '08 recession was much more a focus on financial institutions and their frailty, and that this time around we have more robustness in the financial institutions, less leverage, and overall just more trust in the system. I'd say there are various different kinds of recessions, structural, such as '08, when we did have this fracture in the financial system. We would have a cyclical recession, which is what was generally being expected in '23. And then we have this event-driven recession. This could be something like a war. 9/11 could have triggered such a recession, did not, but it could have. And we also know that these tariffs will be considered an event-driven recession. So what is notable about an event-driven recession? The good news is that the actual decline, the median decline is lower than it would be for a structural recession. So we know that there are parts of the structure that are still robust. And we also know that in terms of the length of this recession, because it is event driven, tends to be shorter on average, actually half the length of a cyclical recession and almost 1/4 the length of a structural recession. So if this is in fact an event driven recession, there's some silver lining that it may not be as severe as other recessions have been. possibly because all of that positive structure is still in place, and the lack of over leverage, the lack of frailty in the financial system. Of course, even at 0.27% median decline and a 9-month length, that can actually start to cause structural issues. And we will be watching for that very carefully. But I'd say that the key challenge here is for this event-driven recession not to slip in to a structural recession, nor to coincide with a cyclical recession, because that could be then a double up of the recession indicators. But at least given it's event-driven, we might expect a slightly shorter time frame around that. Staying on the sentiment indicator, again, and staying on the discussion of historic recessions, it is interesting to compare the spread of the bears versus the bulls as an indication just of sentiment and how much negativity is in place. And there's some suggestion, of course, looking at charts, that negativity like this, the spread of the bears over the bulls, can usually be a time to buy. We've seen that this has been at its most extreme in the past around, interestingly, the Gulf War, 1990. Then in 2009, which was at the bottom of the GFC, there was quite a lot of bearishness in stock markets then. After that, the growing inflation post-COVID in 22, this would have been the time of the double-digit inflation. That caused a lot of bearishness. And then the current tariff regime is the fourth highest bearish indicator of previous time periods. It is notable that this has been higher than even the subprime crisis, which was the precursor to the full-blown GFC, that the bearishness in place today is higher than it was then, than it was at the 03 Iraq invasion, or the post-growth scare after the GFC in 2010, as well as the taper tantrum in 2013. So I'd say we are fairly bearish in historical terms at this juncture. Again, but because it is an event-driven situation, if events reverse, this could give cause for a more positive outcome. Speaking about still the element of uncertainty, and this has become now a banner phrase across markets, that we are dealing with peak uncertainty. We know now that the IMF has started to warn about that, as has the US Fed. They are talking about off the charts trade uncertainty. And just to underscore what a difficult fix this is, and how even the fact that 90 days have been given to negotiate really should not be a particularly positive indicator. We see that the Japan delegation arrived in the US with much fanfare, but they left without a deal. And they were essentially the first in queue. So hearing this, we know that trade negotiations are not easy. They are protracted. And we have a lot of distractions currently in play at the US government. There have been press releases and press conferences relating to El Salvador prison, and a lot of extra, as well as the defunding of certain Ivy League institutions. This has all been headline news that is competing with the tariff negotiations for attention. But behind the scenes, they are progressing very slowly. And I think if we have to then do this times 70, the idea of reaching a satisfactory deal in 90 days seems quite illusory. So I'd say this is really just underscoring the uncertainty that continues in markets. Moving to interest rates. So we know the Fed has decided not to move rates at the moment. They are data dependent. They are cautious that there would be a slowdown in growth, as well as a potential uptick in inflation with tariffs. They've stopped using the word transitory. And however, they have also indicated they're unlikely to step in to salvage markets should they be on the brink of a crash. Meanwhile, in Europe, they have cut the benchmark rate for a seventh time. That was broadly expected. We know that inflation has been comfortably in check in Europe, and that the combination of fiscal stimulus and monetary stimulus seems to be the medicine that that region is applying in order to kickstart some of the sluggish growth in that region. They are not too worried about stagflation, given the inflation part isn't as severe. So they are remaining worried about the stagnation part and the economic growth. So 7 rate cuts just made by the ECB, now at 2.25%. And we know that President Trump, even cited that in a press release today when he was calling upon Jerome Powell to cut rates, disappointed with him, wishing he could be terminated. There has been certainly looking wistfully at Europe. The interesting thing when we look at the dollar is that this should, in theory, lead the euro to weaken relative to the dollar, but the dollar has been under assault by other forces, such as forced selling and just a general lack of trust, unraveling of trust in the US as a trade partner, as well as a general sense of wanting to exit at least some US assets. So we've seen that impact on the dollar. We haven't seen the interest rate differential have that much of an effect. We know from markets that the extremes have been tested. Just moving to markets now, this chart will show the performance since the 14th of April, so just in a week. Markets are down, some volatility, definitely moving on noise, but overall more bearish when we certainly when they start to weigh the words of Jerome Powell. One classic example of how there is very little tolerance for disappointment today is to look at the United Healthcare, which is down. That share is down 24% over the last 5 days, following a dramatic drop in one day. So that is after they announced their earnings. And I think it's worth going through a little bit of what their earnings and revenues, actually the story they told. The story told by United Healthcare was that their revenues were up 10% year on year. Their adjusted EPS was broadly in line with consensus, slightly below. They did cut their guidance for EPS. That was a reasonably significant cut, about 10%. And why? Because they had higher than expected Medicare Advantage utilization. They had high cost new members, and they higher than modeled. And this was all despite improving margins. So some of the headlines that captured this were suggesting that people were going to the doctor too much, or that people were getting sicker, or they were certainly taking advantage of Medicare. This is a little surprising that we see this uptick in use of medical services, particularly when we combine it with some of the increased use of obesity drugs, etc., which should, in the longer term, at least have a seriously positive effect on the health of the populace. But again, this could be a factor just in terms of the dependency of many citizens on Medicare. And if this is the trend that is being perceived by United Healthcare, we know that this will certainly be contagious across other healthcare providers. So there has been a sell-off in the insurance segment today. And this, again, just shows how indiscriminate now some of the market punishment is, because we do know that the healthcare was seen as a more defensive value stock, perhaps relative to the higher growth stocks that did show the most sensitivity to tariffs. So I'd say that from here, we are certainly seeing that markets are not in the mood to reward any shred of disappointment whatsoever. In terms of other unintended effects of some of the dramatic movements, we'll show a chart relating to the dollar shortly, but we do know that currency volatility is now at multi-year highs. Now, multi-year does not necessarily mean decades long, and in this case, we're just going back 2 years, but it has been boosting a demand for currency hedging. Some of the sharp moves in the dollar have perhaps left some US overseas buyers flat-footed and scrambling to make up the difference. So that has also all been consistent with the chart we showed last week in terms of the increase of trading at the banks. So again, unintended consequences, but more volatility in currency markets than we've seen before. And this also contributes to uncertainty. I saw an interesting headline regarding Netflix, that Netflix bucking the trend of other so-called tech companies, showing its profits jumping 24%. It's really a media company, but it often has been bracketed with the tech group. 24% jump in profits as viewers flock to streaming shows and sports. And certainly the some of the wrestling, the live wrestling, as well as the show Adolescence is relating to that. But when I saw this headline, it reminded me of what's called the lipstick index. If we think about a little luxury, and we know it's been the case even since World War II, that a well-priced luxury item, for example, like lipstick, does not tend to see a slackening of demand in a recession. If anything, we see a demand for lipstick increase because it's a small treat, it's generally affordable, and in the absence of being able to spend large amounts of money on other areas, it's nice to be able to treat oneself perhaps with lipstick. To me, Netflix is almost exactly the same as this. Netflix is not an extravagance. It is generally it is a well-used subscription, and it would seem that the use of Netflix could be a substitute for other more expensive treats, such as going out to the cinema, going out in the evening, and other entertainment, all of which has been rising in price with the rise in inflation. So I would suggest that there will be more staying at home watching Netflix, which is a relatively small monthly cost, and that this could be a sign that we're going to see less spending on cruises, on international travel, and on other more lavish forms of entertainment. I think it's worth showing a chart of the dollar, as really a picture is worth 1,000 words. When we see the dramatic movements in the dollar since, whereas it went up between winning the presidency and inauguration, it really has been quite volatile and downhill, most severely recently post Liberation Day. So again, also indication of other rumblings in terms of sell-offs from other groups, and the greenback, as I said, is a safety asset no longer assured. Looking into other assets, we've continued to see flows into gold. We've seen assets in the biggest gold fund topping the landmark, with now $100 billion sheltering there in gold. We know that gold pricing has continued to be very robust. And the interesting comparison to gold, and I haven't seen this before, is copper. Whereas gold would be a defensive asset, a safety asset at times of lack of confidence in global growth or in global governments. When it comes to copper, copper is the opposite. Copper tends to be a play on emerging market demand, as well as on demand for emerging markets from developed markets, and it is generally a play on growth. And what we've seen is that there has been, it is close to a low point, the gold copper ratio, given just how the copper gold ratio, given how much copper has fallen and gold has risen. So that has been higher in the past, and it is quite low. It said it's concerning, but it doesn't necessarily guarantee a recession. So what this chart would tell us is that demand for copper is low, demand for gold is high. The copper gold ratio being low is a sign that we are definitely at peak divergence in terms of those expectations. And that is it for this week. It is not needed as many podcast updates this week. Thankfully, we've had a bit of reprieve from the dramatic market moving news flow. We're now entering the Easter weekend. It's a little quieter in Europe, certainly, as well as in the US. With most markets will be open, but there will at least be fewer activities on Friday. So we might have some reprieve from news flow. Thank you very much for joining us. Have a happy Easter.